There are plenty of growth stocks out there, but that doesn't necessarily mean that they're any good. Today, I'm going to be highlighting 3 separate growth stocks that I think have a good balance of growth, have performed very well, but also are not crazy overvalued. So the first one we're looking at is Sprouts Farmers Market. I'm trying to mix it up. This isn't a tech-centric stock. Most growth stocks are tech. That's just the reality of it. They have the easiest ability with the technological invention to just shoot right up. Sprouts is not that. They have done very, very well. Since they've IPO'd in 2013, they actually have been flat most of the time, except for very recently. They got new leadership at Lowe's, or I think around 2020-ish. I haven't followed the company as closely for a super long period of time, but basically since changing leadership, they've turned things around dramatically. They are a grocery chain, a retail chain focused. It's like a Whole Foods, like a local Whole Foods. It's not super large at 13 billion, but its PE ratio really isn't that insanely high for the run it's been on. All right, 5 years, 550%. The S&P 500, which is usually a good benchmark to look at, which top 500 companies in the United States, over the last 5 years, it's up about 90%. 10 years, it's up about 200%, a little bit more if you include dividend, and its PE ratio is right around 30. So we get a stock right here, 37 PE, and it's blown the S&P 500 out of the water. You can see forward PE is 30, S&P 500 forward PE is about 23. So by every metric, you have a company that has blown the S&P 500 out of the water by many, many multiples, but is only, it's significantly higher, maybe 50%. If you go by the most extreme margin, 50% more expensive, but has outperformed dramatically more. So that's kind of what you're looking for. However, of course, with all growth stocks, you have to factor in, okay, if this starts growing like a normal company, the PE ratio is probably going to retract a little bit and you're going to lose some value there. But if they keep growing at the rates you are, you're going to make your money back very quickly. Next one we're looking at is Camtech. This is also a very small company, or a fairly small company, 3.7 billion. Usually I don't like to put too much stock into companies under 5 billion, but anything over, 2 or 3 billion is fine, but it gets a little bit murkier when they're this small because it's a lot easier to hide things. Apple isn't going to be like, yeah, we were cooking all the books and all. I mean, they could, but it's a lot harder to do so. There's a lot more people involved. There's a lot of wheels. Something with a smaller company, it's easier to do that. So you have to have some inherent risk baked into it. I'm not saying Camtech's doing that, but it's a lot easier to get away with that with smaller companies. 3.7 billion really isn't that large in today's world. Probably many of you watching this video work for a company much, much larger than this. However, last 5 years, 653%. PE ratio also of almost exactly 37. If we look at the forward PE ratio, you're at 23. So by every metric, if you're looking for a company that has that risk reward ratio and you don't mind smaller ones, this is a good one. They do semiconductor related stuff. I don't have the time in this video to dive precisely into what they do, but of course do your own research on that. This is a company, off of all-time highs. It peaked at 130, it's now at 82. A company that has almost the exact same forward PE as the S&P 500, and a company that has over the last 5 years over 6x the performance. If we zoom out, it looks even better. They've just been a small company. They haven't been a huge player in many things since they've been public, but they're a company that has performed well, also dividend above S&P 500. So this is a company that has done very, very well. If you're looking for a company to take a flyer on, that if it keeps growing at these rates anywhere close to it, you're going to make your money back very, very, very quickly. So Camtech's one you should look into if you're interested. Palo Alto Networks is another one that has done very well. You have a little bit less of the risk reward ratio on this one because it's a little bit more expensive, but it is a much larger company, so kind of the risks with it's being smaller, not really around with this. Palo Alto does a lot of data center stuff, therefore AI. Data centers may be all-encompassing. You kind of associate more with data itself, but basically an AI data center and a data center are pretty similar. I work at a pseudo data center, so a lot of the stuff it translates. A lot of the infrastructure is the same, but Palo Alto does stuff related to that. Of course, don't have time to get into the details, the nitty gritty of it. They have performed very, very well, 378% over the last 5 years. P ratio, like I said, of 48. If you take a look at the forward PE, so yeah, your forward PE is higher, so you're basically paying double to triple the S&P 500. So it is a lot, but if you zoom out, it looks very good. It's only really been around since, was that 2012? But since, it would be early 2015, a decade ago, you're up from 23. So you've dramatically outperformed the S&P 500. You've well over 3x the performance, right, from 25 to 186. S&P 500 is only up 200%. So the fact that your PE is that high isn't that concerning as long as you continue to grow at the rates you are. And you're going to have to pay a premium for a company that is large and in one of the most high demand and high growth fields in the entire world. That's just the reality of it. Now, if that's not what you're looking for, nothing wrong with that. I don't own Palo Alto personally. I don't own any of these stocks. Not that I'm totally against it. It's just there's some other ones I think that are better value right now. But if you're looking for growth stocks, I already own some growth stocks. If you're looking for new growth stocks, these are some decent ones to take some flyers on. Now, of course, not a recommendation. I'm not saying you need to buy these. I'm not telling you to do anything. However, this is what personally, if I was looking for a flyer, if I was looking for a growth stock that has a decent risk reward ratio, of value, of growth, of what they do, I think these are some of the better ones out there. And that's really all I got for this video, guys. If you enjoyed it, I appreciate if you like or subscribe. I do daily stock content on this channel, and I appreciate all of you for watching. I'll catch you next time.